Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, if you're investing like 2026 is going to look anything like the last 2 years, you are setting yourself up to lose money. Stocks have delivered incredibly strong returns, but the backdrop is changing fast. Midterm elections, a Fed pivot, and a fragile labor market are all lining up to make 2026 one of the most important markets of this cycle. That's why I'm laying out my 2026 investing playbook, the three major catalysts to stocks, how I'm thinking about risk and return, and then the 7 stocks I'm buying right now. Stick around and I'll also update you on shares of Amazon, ticker AMZN, Broadcom Inc., AVGO, and our stock market outlook. First to that 2026 playbook though, because even after the sell-off since November, stocks have returned 16% so far this year. But between midterm elections, a slowing jobs market, and the Fed, 2026 could be wildly different, and I want you to be ready for it. Even for us long-term buy and hold investors, it pays to think through these major events coming and how it could affect stocks, so I want to lay out a 2026 playbook along with the stocks I'm watching for the new year. And while it's not Twilight Zone level of similar, this year struck me a lot as very similar to 2018, with stocks doing very well most of the year before that sell-off in the last few months. That sell-off was much worse back then and could get worse now, but if you had stayed invested, you would have made a lot of money. So maybe the biggest lesson is just to have that confidence in your stocks and that the market will always recover to new highs. One of the biggest influences on stocks in 2026 could be the midterm elections, and while history never repeats, it does often rhyme, so it can be helpful to see what happened in those past cycles. The path of stocks during midterm years, going back to 1931, has been significantly different from other years. Midterm markets tend to stagnate for most of the year until the election is over, early in November, but then jump higher throughout the rest of the year. That could be a reflection of the market's just hate for that uncertainty, so flatlining as investors worry about what comes next, but then breathing that collective sigh of relief when we at least know which way the wind is going to blow. During those years, stocks also tend to be more volatile though, with the standard deviation, so that rise and fall of prices around an average at 16% during the midterm years versus just 13% volatility in other years. We tend to see the highest volatility, so stocks jumping and falling rapidly the closer we get to those November elections, especially from June through October here. This is likely due to candidates constantly drawing attention to those economic problems and then making promises around the solutions. Add both of those up, and investors shouldn't get their hopes up for a big bounce back early in 2026 if the market does trade sideways. Expect stocks to trade up and down with a lot of volatility, but maybe not go anywhere with any real direction. That would make options trading a good bet, or just taking those profits quickly when they do come along, rather than that buy and hold approach. On the upside though, besides that trend to strong returns after the election, stocks tend to do well the year after that as well. In data back to 1950, stocks returned 15% in the year after midterms versus an average 7% return in all others. Now, typically we see the party occupying the White House lose seats in Congress, so that return could be just a function of a deadlocked Washington getting out of the way of business in the years after midterms. Now, I don't want you to wrap up your entire investing strategy around what usually happens, because that analogy to 2018 might hold up here and break the mold for 2026. That was also a midterm election year, and stocks did well until the October crash that actually took the markets down to a loss for that year. After that, and contrary to what we usually see in the years after a midterm, stocks staged an enormous rebound until the sell-off in May, rebounded until another sell-off in August, and then jumped into the end of the year. So those elections are just one piece of that 2026 puzzle, and it is a jigsaw next year with the president choosing a new Fed chair to replace Powell. Whoever he picks, like recent appointee Stephen Moran, it's likely to be someone in favor of those lower rates. The CME FedWatch tool, which uses interest rate futures to forecast odds of future rate cuts, shows the market now expects just 2 rate cuts in 2026, one in March and another in July, but then no more until July 2027. Now, stocks love those lower rates, and that's not much to look forward to, but if the Fed does start talking about pushing for lower rates, and there's a good chance it does, that could help push stock prices higher. Then the big wild card next year is going to be jobs and that consumer spending that follows it. The monthly jobs report has been extremely weak since February, with some months showing a loss of jobs and basically a labor market that is flatlined. That has caused the unemployment rate to rise to 4.6% last month, from a low of 3.8% last year, as the US just isn't adding enough jobs to account for new workers. Now, so far, that hasn't hurt consumer spending, with most retailers reporting fairly good holiday shopping numbers. Overall, retail sales have grown around 4% annual pace over the last few months, but there is a disconnect that could signal a slowdown. The Consumer Confidence Survey shows people getting progressively pessimistic and worried about that jobs picture. If employment does continue to get worse and it bleeds into shopping, that slowdown in spending is going to start to hit the economy. Now, of course, stocks are not the economy and don't have to follow it lower or higher, but a recession isn't going to be good for the market's direction, especially with that layered in the uncertainty around the midterm elections. Now, against what seems to be a bearish or a slightly negative outlook at least for the first half of 2026, we do see some much better prices for stocks after the last month and that potential for AI-driven productivity to boost the economy. Despite that weakening jobs market, economic growth has been really good this year, with GDP up around 3.8% from last year. And much of that is thanks to the hundreds of billions of dollars being spent in that AI buildout, which, if it follows the trend we saw in the internet buildout in the late 90s, we could still see that investment continue to support the overall economy for years to come. And more than just that business spending possibly covering for some weaker consumer spending in the economy, we're also starting to see the use of AI leading to productivity gains as well. Economists at Citi estimate that AI could boost productivity, that amount of output for the workforce, by 0.5% to 1.5% or more over the next few years. That might not seem like much, but even a 1% productivity boost to a $30 trillion economy is like adding a $300 billion stimulus program. While there are short-term trades you can make in this kind of an environment, maybe using options to hedge that first half weakness in stocks, or just holding a little more cash to buy in on any bigger dips on that increased volatility, I want to focus on the three big themes and the stocks within those that I'm buying. If you're just thinking through these big market moving events coming in 2026 and trying to trade around that, you're going to be making investing more like gambling and less like making your money work for you. Now, first up, AI is the most obvious theme, though not my favorite of the three. Stocks in the Global X AI and Technology ETF are down almost 4% over the last 2 months, underperforming the S&P 500, down just 0.5% in that time, but there is little doubt that AI is going to change our lives. We could still see that sell-off continue for another 5 or 10% lower, but I've shown in other videos that why I think that AI bubble inflates for at least another 12 to 18 months before it pops, if even then. Investment spending for AI infrastructure is still forecast over $400 billion in 2026, and business demand for AI use cases continues to drive that demand for that AI buildout. And that means stocks in the space, especially the hardest hit over the last month, are still at the top of my list for buying the dip. Shares of Amazon, ticker AMZN, are only down 12% from their peak, but are a great place to start here, especially for a safer investment. The company is the leader in e-commerce and cloud services, has a fast-growing advertising segment, and is the least expensive of the 10 stocks I recently researched for the coming chip wars. Also from that chip wars video, shares of Broadcom, ticker AVGO, are down 19%, almost into bear market territory over the last month, but are still expected to post 29% revenue growth this year and next. The stock is still on the expensive side compared to some of the others in this theme, but no other company besides maybe Nvidia touches as many parts of that AI data center, from networking to hardware and into chips. And Nation, I am just as confident in Supermicrocomputer, ticker SMCI, now as when I started buying it last year at $18 a share. The stock has been crushed, down 48% since early October, but the company is the leader in AI services and expected to post high double-digit revenue growth to $44 billion over the next 2 years. That puts the shares deep into value territory, just 0.4 times on a price-to-sales valuation on that 2027 forecasted revenue, which means this stock could be 3 times higher where it is now, and it would still not be expensive. My favorite growth theme, though, for 2026 is in the coming era of tokenization and stablecoins, and what it means for the Ethereum along with other related stocks. Nation, this isn't about being a crypto bro anymore. With JP Morgan's tokenization of money market funds, a first step in converting that $7 trillion money market industry into the blockchain technology, we are seeing an unstoppable shift in finance. Even longtime skeptics like BlackRock CEO Larry Fink have come around to recognize the efficiency, lower cost, and convenience of tokenizing investments, at one point saying every stock, every bond, every asset can be tokenized, and moving us closer to a $19 trillion market for that industry. I realize the idea that blockchain technology and crypto can seem like tech nerd nonsense, but all you really need to understand here is this is going to happen, and that 70% of tokenization and stablecoin volume is done through the Ethereum network. Now that means as that tokenization grows into the trillions of dollars in assets, the volumes in trading for Ethereum are going to surge, and it's why I'm buying the iShares Ethereum ETF, the ticker ETHA, as a way to hold that cryptocurrency. I'm not sure we get to Tom Lee's prediction of $60,000 Ethereum in 2026, but I do know that Congress, under Republican control right now, is trying to move very quickly on codifying crypto legislation before the midterms in November. Another way to invest in this theme is through the Amplify Blockchain Technology ETF, the ticker BLOK, which holds shares of 56 companies across the crypto universe, from platforms like Coinbase to miners like Hut8, and then exposure into the tokens themselves. Another longer-term theme here, but one of my favorites, is in cybersecurity stocks, though the group has been a mixed bag this year. Stocks like Cloudflare, ticker NET, CrowdStrike Holdings, CRWD, and Zscaler, ticker ZS, have jumped as much as 80%, while Palo Alto Networks, PANW, is up just 3%, and Fortinet, FTNT, is down 16% this year. The group also hasn't been immune from this sell-off, with some of the top performers falling hard since November. But as I've been saying, this is one area of IT spending that cannot be cut. More than 7 in 10 companies with over $5 billion in revenue got hit by a ransomware attack last year, and it's 60% across all companies. Those attacks cost an average of $5 million and up into the hundreds of millions, which means that 12% annual growth expected in cybersecurity spending is not going to slow down and is likely only going to grow faster. I like shares of CrowdStrike Holdings, ticker CRWD, for the company's lead in AI cybersecurity and its revenue growth, while Palo Alto Networks, PANW, is a must-buy on its valuation and the potential in recent acquisitions. Beyond buying more of those two right now, I also hold most of the bigger names here, like Fortinet, Zscaler, and Okta Inc. These aren't the only stocks to watch in 2026, but they are my favorites and the themes I'm most confident in that upside. I'm going to be updating our outlook in other themes though, like quantum computing and gold, in the coming weeks, so make sure you tap that subscribe button so you don't miss a single episode. Looking at the stocks I'm watching this week, Bloom Energy, ticker BE, is down 40% in the last month, even against the strong rebound with the rest of the AI theme last Friday. This could be one of the most leveraged investments in that AI theme and is an attractive price after the sell-off. Bloom has designed a distributed generation platform that is reliable and scalable to data center needs. Now, we all know that the power generation is one of, if not the biggest bottleneck to that AI data center build-out, and Bloom's solid oxide cell technology can be co-located next to a data center in as little as 90 days. The company is expected to post 30% revenue growth this year and next, and is already profitable to 54 cents per share this year. It's not super cheap at 10 times on a price to this year's sales, even after that sell-off, but is a steep discount to where it was just 2 months ago. And here, Rivian Automotive, ticker RIVN, was up 23% last week and 80% since the beginning of November, as that EV maker starts looking more like the company I think it can be. I've been recommending the shares since $10 each last year on the company's partnership with Volkswagen, as well as the potential to lease its software to other car makers, moves that clear up funding concerns for that growth. Just recently, Rivian announced custom chips and robotaxi potential in its cars, as well as a refresh of its best-selling vehicle. It's not completely out of the woods, but with 27% revenue growth expected next year to $6.8 billion, it pushes aside a lot of those fears and takes the company closer to that breakout moment like we saw with Tesla 5 years ago. Updating our stock market outlook, there's no market-moving economic data scheduled for the week and no earnings announcements. Now combine that with very light volume as many traders and institutional investors take the week off, and you've got all the recipe for big swings in stocks, as any unexpected event can cause volatility when there's just few buyers and sellers left to set prices. Now that said, I would resist the urge for any knee-jerk reactions on big price swings because they often snap back the other way before the week is out or even before the day closes. 2026 is going to be a pivotal year for stocks. Following 3 years of a bull market with stocks in the S&P 500 up 90% since that 2022 low, we're likely to see more frequent sell-offs of 5 or 10% as this cycle gets older. Besides that uncertainty around the Fed rate cuts and the midterm elections, investors are going to want to see that investment spending and AI theme can continue and support those stocks higher. I'll be right there with you, bringing you those videos, but have a Merry Christmas and a Happy New Year out there, Bowtie Nation. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.